coming today. We're excited to do this presentation in collaboration with Canada Life. This will be a Universal Life, what's new. I'm always interested to hear what's new with Universal Life. I always feel like I need a refresher once in a while too, so this is great. We're happy to have Canada Life, as I said, with us today. That'll be Warren Stephenson. He's the Director of Non-Par Sales for Canada Life, and he'll introduce himself soon. I'm just going to get over a few notes here. In regards to this being recorded, it will be recorded. Next week, it will be available on our website and available for you to watch again. It is CA accredited in every province. Specifically, when it comes to Quebec advisors, please enter your AMF number on the poll throughout the presentation. We will do that. I did want to just speak a little bit about Universal Life quickly. Universal Life represented, as per LIMRA, Universal Life represented 13% of the total Canadian new annualized premium for 2023. So definitely a topic of conversation. And I'm Emily Sorensen. I'm the BDE for here in Southern Alberta, Calgary specifically. Happy to be here today to help introduce our speaker, answer some questions as we go. So if you have a few questions, pop it in the Q&A or the chat, and I will address it as we go. And I will turn this now over to Warren. Warren, thank you for coming today.
Perfect. Thanks, Emily. Just a quick pulse check. Can you hear and see me?
Yes, I can.
Perfect. Well, with that said, thanks for the introduction and for your time today. Thanks, everyone, for taking time out of your busy day to be here. And for your interest in learning a little bit more about universal life insurance. So thanks for taking time out of your day. I'll just give a super high level, I guess, overview of who I am in my role. So I'm obviously Warren Stephenson, the Director of Sales Enablement for Non-Participating Insurance with Canada Life. And sort of what my role is, and I've been with Canada Life for, this will be the 20th year. I've been lucky enough to be part of Canada Life. Well, my role is basically to work very closely with both our wholesale team. Hopefully you all know your Canada Life wholesaler. If you don't, you can reach out to me and I can help connect you with your local wholesaler. But I work very closely with that wholesale team, as well as staying connected to advisors to really understand what you need in the field to help position and sell more insurance within your client's overall financial plan. And then I'd be tasked with helping to create some of that material. So that's one aspect of my job. The other aspect of my job would be to be very close to our product development partners and to sort of be a check on them. Because I think, if we were to let our pricing folks do, whatever it is that they want to do, I think we'd end up finding that we have an extremely profitable product that no one sells. If we just let our distribution folks, always get their way, I think we'd have an extremely sellable product, but wouldn't make any money. And so I'm sort of tasked with being that bridge between those two competing interests. So sort of providing some healthy friction between those two bodies. So with that said, I was very connected with our pricing folks as we were developing our latest universal life insurance changes. And hence, I guess, partially what we want to talk to you about today, which is Canada Life's overall universal life product shelf. So I'll give a fairly high level, just to help us level set on what UL is all about, Universal Life is all about, how it works, how it functions, maybe some tips and tricks if you're relatively new to really doing a deep dive into UL. But I don't want to just talk about that. We'll also talk about some case studies. So I want to let you leave here with some interesting case study examples that you might be able to think about your own business, your own prospects, to see if there's a fit for universal life within your book of business. So again, we'll just talk a little bit about universal life's high level features. Again, I'll be very quick on this, but I think it'll be good to level set here. So what is UL, universal life? Frankly, it's a permanent life insurance product that also has a tax advantage or tax-free investment component to it. I think fundamentally the advantage of UL is in its flexibility, in its ability to be customized to meet the needs of a particular client. So let's talk about choice for a second. So Universal Life has a variety of choices that both you and your client can select from. One would be the cost of insurance. So do you want a level cost of insurance that will remain the same throughout the contract's life? Or do you want more of an annually increasing cost of insurance pattern that might start lower today, and there might be an exchange for its lower premium today? Obviously, it might be a little bit more cost effective in the short term, but also there might be some advantages in terms of the amount of room that's available for overfunding that policy within a tax-free investment environment. So there's choice between levels cost of insurance or annually increasing. And what Canada Life also introduced back on February the 12th of this year is we have now 2 annually increasing cost of insurance options to select from, annually increasing to age 85 or annually increasing to age 100. And we'll do a bit of a deeper dive on that in a moment. Again, speaking about universal life, its inherent flexibility, it's incredibly flexible in terms of payment of those premiums. So the client can decide how much to pay, and if they are overfunding, how they want to invest that overfunding. Again, extremely flexible. A client has changing cash flow, changing abilities to pay, or they're projecting that a different liquidity environment within their own financial plan. They have the ability to tweak and to change how much they might want to pay for that product over time. To again utilize the tax exempt nature of the product. Again, choice, flexibility, investment accounts. The client would have a wide spectrum of investment accounts to choose from between daily interest options, guaranteed interest options, or more managed or indexed portfolios as well. So again, universal life, very flexible insurance product. Again, like when I'm working with advisors, I think most advisors, if not most people overall, like to have some tips and tricks or again, like shorthand for why would I sell this particular thing? In this case, it's universal life. And to me, like looking at universal life extremely closely on behalf of a client would really come down to 5 main reasons that I would see that you might want to look very closely at universal life. Hopefully Canada Life's universal life, but universal life overall. One would be, again, it's the lowest cost permanent life insurance solution available. So if a client has a permanent insurance need, level COI universal life can be 20, 25, maybe even a little bit less expensive than a comparable delayed value PAR product with an enhanced dividend option. So if you're looking at PAR, the least expensive or the most cost efficient PAR product to get a certain level of death benefit today, level COI UL is probably going to be about 20 to 25% less expensive than that solution. So again, very affordable permanent life insurance protection that will be with a client permanently. Client control. We spoke a little bit about client control, but again, universal life provides a lot of inherent control and flexibility to the client. So speaking about control, again, there's a choice of cost of insurance options. As we spoke about last slide, you can do annually increasing. Again, 2 different options to choose from there, or level. A client can make unlimited payments into that policy without underwriting. Obviously, there's a tax-exempt limit, and any amount deposited above that limit would go to a side account. But again, incredibly flexible in terms of being able to make payments into that insurance solution. And in fact, speaking about payments aren't even required if there's an investment account within that policy that has a balance that will at least cover the next monthly cost of insurance charge. So again, thinking about a client, maybe it's a business owner, varying cash flows, they're planning on a particular level of funding for a policy, but there's a great investment opportunity within that business, and the client now wants to invest, within that investment option within their business. They might have less flexibility to pay for their insurance solution. Again, UL allows that flexibility to vary premiums up or down to help better align with client cash flows. Flexibility. UL is also a very good solution for folks who again don't necessarily know what the future will bring in terms of cash flow. So my mind would go to individuals who would be a good fit for UL would be, again, business owners, spoke a bit about them. Again, don't know what the future might hold, whether cash flow is good today. Maybe there'll be a business issue in the future where they might not have as much liquidity in the future, again, you can tailor your premiums down. If business is extremely well and you want to overfund, you can overfund within universal life. I think very similarly, families might be looking at families who are planning for their future, looking at a maternity or parental leave. Universal life is very good in terms of being able to adjust for that changing cash flow environment. You can also look at single clients. So my mind might go to young economic growers who want to start their insurance journey. They know, they're planning for their future. They know at some point they're going to get married. At some point they're going to have a kid. At some point they're going to perhaps start a business. Universal life is a very flexible product that could help a client with that type of characteristic. UL is also extremely transparent by its very nature. It provides a lot of access to information. And I think that access to information can really help a client, monitor and make planning decisions with this insurance solution over time. So for example, unlike other insurance solutions, Universal Life provides full visibility to a lot of different investment components. And with that access to information, both you and your client can help develop a plan to maximize that product for the needs both today as well as their needs change over time. As an example, a client might choose annually increasing cost of insurance today when their cash flow would really only support annually increasing cost of insurance. And then they can do a COI switch to level cost of insurance when their cash allows in the future. With respect to transparency to fees, a client might choose, for example, if they know there's a surrender charge, they might choose to delay accessing cash until another year, for example. So if you have, the need to put a new roof on the house, you might be thinking about dipping into your UL policy to help, provide some of that liquidity to respond to that now new demand on your finances. If you know there's a surrender charge, you might decide, you know what, I'm not going to pull from that particular pocket. I'll pull from a different product or different asset that I might have. Provincial premium tax. Again, that's transparent with respect to universal life. And depending on what happens with provincial premium tax, a client might choose to tweak how they intend to fund this product. So if a provincial premium tax increases in the future, a client might look at that data point and decide, you know what, I'm going to do a little less overfunding than I was originally planning. Or on the flip side, if a provincial premium tax goes down, as Quebec recently reduced their provincial premium tax, a client might look at that and say, you know what, I was planning on funding at this particular level. Provincial premium tax is down. You know what, this is a little bit more efficient today. I'm going to actually increase what I was intending to put into that particular asset. Again, a wide variety of investment options that you can use to tailor solutions for your clients as well. Some other whole life products are typically supported by the insurer with, again, typically conservative fixed income based assets, but universal life insurance would allow you and your client to select an investment account that matches their needs, their risk tolerance, or their view of the future. If you have a very optimistic client or a client who's very accustomed to managing an investment portfolio, they've done it very well, they're comfortable with equity, you could go 100% equity within your UL investment option if you wanted. Or again, you can mix and match, and you don't have to be tied to the selection that you make today. You can make changes to how you invest within that UL policy over time as maybe economic circumstances change and the client's outlook of the future changes. Or again, their risk just changes. They're happy taking on a little bit more risk in the early years, and then they want to reduce their equity exposure over time. UL would allow both you and your client to make some of those informed decisions over time. Before we sort of close up this topic, I will provide a bonus reason number 6 why UL might be very attractive for both you, well, particularly you, I guess, in this case, which is, our top UL producers, advisors have really told us that universal life helps them have a much higher cross-sell rate than any other insurance product. It can provide a reason to call your client, stay connected to your client, and really stay informed on their changing life needs. I think rarely do clients purchase an insurance product and put it in the drawer for 30 years or longer. My view would be any insurance product, whether it's participating life insurance or UL. It shouldn't be purchased in that way. But UL really provides an added reason to call a client, at least on an annual basis. Again, if they're doing overfunding, you're not doing a min-funded level cost of insurance, you may want to, really stay close to that client. And sorry, I saw a question pop up there. You might want to stay close to that client. And again, that connection to the client over time, monitoring how the investment is doing with an overfunded UL policy can really help you not develop, because you already have a relationship with a client if you've made a sale, but encourages a stronger bond between your clients, encourages cross sells or referrals to that client's network over time as you prove your value to that client. So again, just a sort of bonus reason why UL might be a product, if you haven't looked very closely at, you may want to look at again. I will provide a little bit of high-level detail on what Canada Life has done with our UL product shelf as of February the 12th of this year. I think as I've been traveling and connecting with advisors, we've heard very strong, consistent, positive feedback with respect to our new investment option, which is called the Stable Growth Account. Not necessarily new in market, but it's a response to those clients who might like Universal Life, or those advisors who might like Universal Life, but they also like some of the investment methodology that comes around with some of the PAR investment accounts. And so our Stable Growth Account is really modeled and has a lot of characteristics that would be similar to Canada Life's PAR account, which is at a super high level, 70-30 asset mix, so 70% fixed income assets, 30% equity asset mix. Stability will be achieved with this fund through smoothing of gains and losses over time, which will help reduce volatility. Growth can be achieved by that investment mix. The fixed income assets provide good, stable, consistent returns. Equity can help provide more upside potential within the portfolio. And that blend, that 70-30 asset mix is really a good long-term asset mix for folks who are interested in an account like this. And our thinking also is that there's really never been a better time, and I wouldn't say this was necessarily planned, but I think it worked out pretty well, is that there's never been a better time to open an account with these types of characteristics. So again, a 70% fixed income asset mix, again, with smoothing of gains and losses. This account is starting from a position of having no negative market exposure, no either realized or unrealized bond losses as interest rates have come up. Bond prices would have been inverse to that. So bond prices would have been down. We're starting at a fairly high level interest environment, yield environment. Again, different than it was 2-3 years ago. So again, this fund is really starting from a position of strength. Looking forward, we have a lot of experience managing a fund like this. We've set the initial crediting rate at 4%, which is a very strong competitive yield or return in market with accounts similar to this. But in addition to that 4%, Canada Life is also funding, so not paid out of future policyholder experience. Canada Life is paying an additional 1% bonus above and beyond that 4%. So that bonus is in place until December 31st, 2025. So this calendar year and next calendar year. So 4 + 1 would be a 5% yield on the Stable Growth Account, which is that yield is also, I've been asked this in the past by advisors, when is that yield paid? So we pay that on a daily basis. So it's valued and paid and credited to a client's account on a daily basis. Just a very quick snapshot between, again, the Stable Growth Account and Canada Life's PAR account. I like this slide. It sort of summarizes a lot of really good points here. So again, similar asset mix, 70% fixed income, 30% equity between both investment accounts. Canada Life's, again, Stable Growth Account is a 5% yield. Our PAR account currently is yielding dividend scale interest rate is currently set at 5.5. That's only one factor on PAR in calculating a dividend that a client will actually receive. On the UL side, that's the only factor. So less to sort of be aware of with UL. Again, going to that transparency conversation. If you got 10 grand in the account, we're paying 5%. Again, it's credited daily, so compound daily. But you could calculate that return on what you'd have at the end of the year with UL. A little bit of a murkier story with PAR, but at least you get a flavor for the crediting rate with the stable growth account or the dividend scale interest rate there. Again, with both accounts, rates are set once per year. They're set at least once per year, I should clarify. So with PAR, again, we have the same ability to go off cycle if we need to. That's come up with our stable growth account because we have wording in the contract that says we'll do it at least once per year. Really, the intention is to do it once per year. It'll be early each calendar year. So think January timeframe is when we'll evaluate and decide whether that rate needs to be increased or decreased or, again, remain the same. We do reserve the ability to go off cycle if there's some type of a market accident or a large market event. But really, the intention is to do it once per year. And I don't know if we've ever gone off cycle with PAR. So it should be a pretty consistent experience there. Both funds have smoothing of gains and losses over time. So again, a consistent experience there. Both funds will never credit a return less than zero. So having a guarantee of zero is one way to put it. From a sales perspective, I'd say both funds have vesting. So once we credit a return to a client stable growth account, that return will never be taken away because of a future market change. So once it's credited, it's vested, it belongs to the client. They'll never have that return decrease in the future. One difference between UL and PAR is once you've made a decision to buy participating life insurance and you've selected a carrier, you're with that carrier and you're with that carrier's participating account. Unlike an RSP, for example, there's no T2033 form with PAR. You can't buy Canada Life's PAR today, switch to Sun in the future, switch to Manual, only to come back to Canada Life if you're chasing returns. You can't do that with PAR. You've made a selection. You're with that product now for that full policy lifetime. But with UL, again, there's a wide spectrum of investment accounts. So you could buy the stable growth account. You could switch to a GIO if you wanted to, or a managed or an index account. Or you could also mix and match. So, if you like a little bit more equity exposure, you could buy or allocate maybe 50 or 75% of your asset mix to the stable growth account and maybe the balance to more equity or fixed income if you like. So there's a little bit more ability to tailor a solution to clients with universal life than there might be with participating life. One call out that I'd make to help show that the stable growth account is not Canada Life's PAR account. Again, often a lot of commonality here, but there are some differences as well. So Canada Life's PAR account does include direct real estate as well as private debt and equity within Canada Life's PAR account holdings. Those asset classes are not in the stable growth account, at least not today. As that fund grows over time, we may look to add those types of assets, but today, direct real estate assets are not assets that are held within the stable growth account, as would be private debt and equity. Again, I get this question fairly frequently as well, which is, hey, you're crediting 5, which is 4 plus the 1% bonus. Your guarantee is 0 within the stable growth account. How should I run my illustrations? I think that comes down to both your comfort with risk, your client's comfort with risk, your outlook for the future. I would say running a UL illustration and showing the minimum guarantee of 0 is it's quite pessimistic in terms of a long-term view, especially with an account structured this way, smoothing of gains and losses, 70% fixed income, 30% equity, 0% projecting that forward for the policy's full life would be an extremely pessimistic view. But that is, in fact, the guarantee. We're crediting 4 plus 1, 5. I probably wouldn't show 5 long term. Now, the fund may return that long term, but for my view, I'd show a client maybe a couple of different illustrations. Maybe show 4, show 3.5, show 3. On the hand side on this slide here, we have example of a 50-year-old male non-smoker doing a solved 10 page. They want 10 out-of-pocket payments. And those numbers would be the annual deposit that they would have to make at those varying yields or rates of return. So again, showing 0 or 1 or even 2 would be pretty pessimistic. Again, I would be very cautious going above 4. But again, showing 4 or 3, I think would be a very good approach to help a client understand or see the inherent value of an account like this and how a UL policy might work for them. Emily, I'll do one more slide before I maybe do a quick pause for question. But what else is new with our UL product? Again, super high level, but we've updated our AI 85 pricing. In the past, it was an extremely steep curve in terms of rates over time. And so we've flattened that curve. So a little bit higher COIs in the early term, but a lot lower in the later term. And I think that's really leading to a lot better client outcomes. So if you're looking at solved limited pay solutions, this pricing curve generally works out a lot better for clients, as does internal rates of return around mortality. You're much better off with our revised AI 85 pricing curve. We also have, as mentioned earlier, an AI 100 product. So that provides the lowest possible early cost, which helps increase overfunding room. What I'd summarize here between AI 85 or 100 is I think AI 100 has less practical applications, frankly, at least in my view, than AI 85. I think folks looking at AI 100 would really be folks who are looking at maximum funding their UL policy. AI 85 probably works best for those solved limited pays or for a client who's looking at doing more moderate overfunding. If you're looking at real max overfunding, AI 100 can be a great solution. AI 85 probably works better for solved limited pays and let's call it moderate overfunding. The other advantage of AI 100 is we can issue that all the way up to age 80, whereas AI 85, the max issue age is age 65. Lastly, we have removed our guaranteed limited pay from our shelf. Frankly, sales of that product, both with Canada Life and the industry, have been extremely low the last 5 years. With interest rates that were at all-time lows, that created pricing pressure. 2017 brought some tax changes that sort of negatively impacted the competitiveness of a guaranteed limited pay. And now we've seen the market move to more of those solved limited pay opportunities. And sorry, Emily, I'll just do two more very quick slides. But if you're asking, I have had folks who have sold a lot of Canada Life limited pay, guaranteed limited pay in the past, and they've questioned, what, like I used to like that product. Tell me why this new solution is better. So provide this slide. So this has, for a male 50 non-smoker, on the left, you have our old, no longer sold, but our old guaranteed limited pay, 10 pay. In the middle, you have a solved 10 pay using AI 85 at a 4% rate. So again, think sort of stable growth account. And then on the right, we have, again, that same scenario, just a different assumed rate of return being 3%. So the guaranteed 10 pay requires a little over $40,000 of annual out-of-pocket costs, so over $400,000 cumulatively over 10 years. Whereas the solved limited pay at 4 or 3 is $100,000 to about $150,000 less out of pocket over 10 years. And then if we turn our eyes more to the bottom of the page, we have 10, 20, and 40 years called out here for death benefit and cash value, as well as IRRs. I would have a very hard time justifying for a client to spend an extra $10,000 to $20,000 a year, $100,000 to $150,000 over 10 years to get that guarantee. And we look at the IRRs, the values that you're getting under either scenario here. I think that the solved limited pay works a whole lot better than the old guaranteed 10 pay. Next slide is very similar to the last slide. This is just more of a corporate scenario. So in the past, that last slide, we were looking at internal rates of return. Now we're looking at equivalent required rates of return. And we're also looking at net estate value. So again, think a corporation paying it out through the CDA to the extent possible, and then net estate values. Again, the solved limited pay works a whole lot better than that old guaranteed 10 pay. Emily, with that said, maybe I'll just push pause and ask if there's any questions.
Hello. Yeah, we don't have any questions yet, so I think we can just proceed at this point. Again, if you guys do want to ask any questions, just, we welcome it in the Q&A or the chat. Thank you.
Perfect. Just very quickly, we've also removed surrender charges for level cost of insurance UL. So it's a bit of a differentiator between us and perhaps some of our competitors. Again, if you're looking for creating collateral that you might take to a bank, for example, the absence of surrender charges can be a helpful feature there. And then lastly, we've doubled our asset-based compensation for index accounts, managed accounts, as well as that stable growth account. So we're paying 0.5% on asset-based comp. And so, I think as you're building a practice, you're working with clients, if you're looking at clients who are doing any degree of overfunding that are going to have assets within an investment account, look very closely at Canada Life. Again, that doubling of asset-based compensation can really be a material difference longer term. We do pay 60% on premiums up to target, and then 5% on deposits above target in the first year. And again, that asset-based comp, I think is really helpful for rewarding you for working with clients, helping them not only at point of sale, but over the length of the contract. I know how hard it is to build a practice, especially from scratch. And so that the increased asset-based comp, I think, is very helpful and helps align you and the valuable work that you do with your clients to the reward, which is being properly compensated for your time. So we'll do a little bit of a competitive analysis. So here what we have on screen is a sampling of Canada Life and some of our competitors. We're looking at our SIO smooth interest option. So again, with Canada Life, think that stable growth account. So we're paying 5% there. We also have DIO and a couple of GIO investment options on screen. I guess what I'd call out here is, I've been watching this pattern trend for a number of months, I would say 6 months or more. And I think that the findings generally have held pretty true. Canada Life has had some extremely attractive, competitive GIO, obviously stable growth account, but also GIO and daily interest option rates. Canada Life has been consistently at the top or at above the top in terms of the competitive set here. So reliably, Canada Life has been sort of at the top of this spectrum here. Again, this was last updated June the 10th, so I guess 3 days ago now. But again, if you're looking at clients who are going to be looking at GIO options, really look closely at Canada Life. We've had some very consistent, at least competitive, if not best in class GIO and DIO rates in market. And here we have a sampling of I guess, limited pay scenario. So here we have a 60-year-old male, $1 million initial death benefit. We're using Canada Life's max premium deposit for 10 years. And we're assuming a 3.5% fund return for each competitor noted here. And then so on the left, we compare, AI 85 options. Industrial Alliance has an increase to age 90 option, so sort of split out there in the middle. And then we have Canada Life's AI 100 on the far right. But again, Canada Life has, I think, extremely competitive. Will we always be number one? As you'll see as we walk through some of these samples, no. But again, I think we have an extremely competitive offering. So here for the 60-year-old cash values, Canada Life's AI 85 is providing extremely competitive cash values. The AI 100 is a little bit better off yet again. But looking at more life expectancy, so age 90 in this example was what we're looking at. Again, Canada Life's death benefit at 90 would be a leading value there, 1.5 million. It's been rounded, obviously. IRR of 3.1%, which is pretty good on an IRR basis. And at the bottom, we also have AI 85, or sorry, the comparison age of 85 called out. So again, Canada Life is extremely competitive. I would say 40 to 45 plus would sort of be our sweet spot. Here we're looking at a 50-year-old. Again, I'd say extremely competitive figures in terms of cash value. 546 at year 10, so that would be the highest value. We're competitive, I would say, at year 20, so above Manu, a little bit below Sun, in the AI 85 spectrum anyways. And again, out at life expectancy, we're rounded here, 1.5, 1.4, or 1.6 million, so all pretty close. But again, Canada Life would be a very competitive player there at those ages. And again, on the far right, we have the AI 100 product called out as well. Next would be a male 40 example. So this is where I'd say Canada Life, if you're looking for sweet spots, I'd say Canada Life's competitiveness is age 40 plus with annually increasing cost of insurance types. Under that, I'd say, hey, look at Canada Life, but I think our sweet spot is really age 40 plus. But again, some very competitive values over time. Again, talking about sweet spots, so here we'll just do a little bit of a deeper dive into UL. So, excuse me. So use cases. Again, if you're looking at what client profile would I sell, what cost of insurance type? Spoke a little bit about it earlier, but if you're looking at folks who are really looking at maximum overfunding, they're really looking for death benefit growth over time. Again, thinking more high net worth clients who are looking for max overfunding opportunities. I think AI 100 can be a very good solution for that type of a client profile. If you're looking for clients who obviously want some control over their investment options, there is a plan to overfund. I think AI 85 can be a very attractive option there. And you can look at both level death benefit or coverage plus. I think both would work well for a client who looks like that. Again, some commitment to overfunding. They want to have control over the investment options. AI 85 can be a great fit. For clients who just want permanent insurance, maybe they want some degree of flexibility, but they really have a preference for a flat cost pattern. Maybe they're looking at more min funding with the thought they might do some overfunding in the future, but it's not really sure. Level COI would be my default selection for a client that looks like that. And again, like clients who might be able to accept some degree of funding risk and they're looking for a limited pay strategy, I think using AI 85 where possible with a level death benefit would probably be the cost type and death benefit option that would work best. It would also be a very good fit for corporate-owned scenarios or clients who are not necessarily looking for a growing death benefit pattern. Maybe they've done an estate freeze. Again, AI 85 level death benefit would be a great fit there. Because AI 100 is new, we'll just spend a little bit of time comparing and contrasting AI 85 and 100. Again, we spoke a little bit about limited pay, what had happened in market. Guaranteed limited pay, obviously, as we see on screen here, has really become less attractive since about 2017. Obviously, we had an ever decreasing interest rate environment shortly after 2017. We had some negative tax changes that would have happened around 2017. And so again, the market has really shifted to more of a solve limited pay as a substitute for a guaranteed limited pay. So I think if you're looking at a limited pay solution, looking at AI 85 or 100 with a reasonable return, let's call it 3% or thereabouts, 3 or 4%, can really drive some very favorable client outcomes looking at that type of a structure and cost profile. So just looking at some tips, I think when looking at solve limited pay or limited pay, I think plan A is really to look at AI 85 where possible. For corporate cases, AI 85 will generally produce more favorable CSV as well as CDA, capital dividend account credits or values. With AI 85, again, doing a solve limited pay, your assumed cash value within the product is likely going to reduce to at or be at zero at age 85, which for a corporate client can actually be a good thing. There is no asset on the corporate balance sheet at that age. Obviously, at death, if you have a product with cash value, that cash value is added to the share value at death. If that life insurance is a common shareholder. And so less cash value can be better if death benefit within a corporate scenario is the main objective. AI 85 also generally provides better CDA values compared to AI 100. For older clients, so clients age 66 to 80, if you're looking for, again, a limited pay, in that example, I look at AI 100 instead of looking at level cost of insurance. So limited pay scenarios, AI 85, where possible. If the client's older, again, I gravitate more to annually increasing to age 100 instead of level cost of insurance. And so we'll sort of try to build or prove that out. So here we have a 60-year-old female on this example, $1 million death benefit. We're doing level COI has to be coverage plus. The AI examples on this slide would be level death benefit. We're using 3% assumed growth rates on all these examples, and again, assuming 10 out-of-pocket payments. So you can see that the sort of difference in required or solved annual premium payments. AI 85 in this case requires about $33,000 of annual deposit or out-of-pocket payments. AI 100 is $47,000, and then level COI, again, trying to accomplish your goals there, would be $55,000. Point to mention though is, again, level cost of insurance is coverage plus. And so if you look at death benefit, if you assume that you're going to die at age 85, the level COI would actually provide you 1.2 million of death benefit, where the others are a million. So a little bit of apples and oranges, trying to compare level death benefit AI versus coverage plus level COI. But again, for someone who's looking for a limited pay, they might be looking at a set need for insurance. They want the lowest out-of-pocket cost. You generally go to level death benefit in that type of scenario. And then if you're there, AI 85 is producing a more favorable outcome, both in terms of out-of-pocket cost, 33,000 versus 47. Same death benefit, but AI 85 is also providing a better CDA value. So again, AI 85 would generally be where I would go for that type of a client. Here, what we have on screen would be cash surrender values over time between AI 85 or 100. And so, again, what would I see here? If you're interested in cash value, having some cash value, especially after age 85, AI 100 is a great solution. But if you're not necessarily looking at cash value as a primary motivating factor for making your selection, again, solve limited pay, you're probably not looking at cash values being critically important. AI 85 can be a better fit. But so that's just an example of the cash value differences over time between those two products. And then here what we have are CDA values. And so AI 85 is shown in that green or turquoise solid line, whereas AI 100 is a dashed line. So AI 85 provides better CDA values throughout the entire length of the contract. So again, another reason why, especially for corporate cases, I'd probably try to go AI 85 if you can. And then this was just another example to just try to stress test the example to see, hey, does that CDA pattern work for a 60-year-old as well as a younger client? So here we're looking at a 45-year-old. This is a male in this example. Again, CDA values are better at every duration sampled here for AI 85 versus 100. So again, corporate cases, if you can, I'd probably go with AI 85. Emily, I'll just push pause here if there's any questions.
Yeah, there are a few. So I'll just go to this one first. Can you on Workspace, can you illustrate and save? It says in order to use comparisons of various options. So I believe they're speaking of maybe the 85, 100, perhaps. Are you able to compare the two options side by side? And if Gordon wants to correct me if I'm wrong interpreting that question.
Sorry, you're cutting out a little bit there for me, Emily, but I think the question was, can you compare them? So short answer is yes, you can. So if you're doing illustration in Workspace, our online illustrator, we've moved exclusively to online illustrations, as the person asking the question seems to know, which is great. Yeah, you can do different scenarios. And so you can do a scenario with AI 85, another scenario with AI 100. You can just produce those PDFs and compare them side by side if you want. We do also have I call it a sales tool, a calculator. We have something called a plan comparison tool. So you can import both of those products into a plan comparison tool and sort of put them side by side. So you can see values over time, just a nice simple one page. If you're looking to have a conversation with a client and show those two values, again, two options. One is print both options and show them, whether it be on screen or on paper, or you can do that plan comparison to help summarize the numbers and just have a nice, concise comparison there. So I hope that answered the question, Emily.
I think so. If not, we'll hear back maybe and address it again. But we also have another question in regards to someone wanting to see a UL 100 option for a client who wishes to have a permanent term-like solution. So, they refer to as a skeletal UL 100 option as an alternative to a permanent term-like solution.
Sorry, I may not fully understand. So are we looking at AI 100 in this scenario, or we're looking for coverage to age 100, lifetime? So obviously you can do
I'm guessing we're probably comparing to like an alternative like T100 or something.
Then yeah, 100%. UL works extremely well for that. So I would do a level cost of insurance, and then just pay the minimum. So that would be your T100 replacement. But absolutely, you can do that.
Okay, and we heard back from our chat on the comparison in Workspace, and it's all good to go. So I think we can proceed. Thank you so much.
Perfect. Well, we've got about 12 minutes left. I do want to run through some case studies. I think we have a couple interesting ones here that will hopefully be beneficial. So, sorry, my screen's not advancing. Here we go. So this is an interesting case that was written not all that long ago, maybe 3 or 4 weeks ago. Again, I thought it was quite interesting. So here we have a 60-year-old male. He owns a successful general contracting company, and he also had what I call a commercial rental property portfolio. So he had some commercial or industrial rental properties. 2 adult kids. One was in med school, so very much unlikely to be involved in the business. The other one was unknown if they would be involved in the business in the future. So I think that point is interesting in that we're not likely looking at an estate freeze scenario here, because we don't know if the kids are going to be joining the business at any point in the future. This client was intending to be active in the business for at least the next 10 years. The business value today was about $7 million. They did have their full lifetime capital gain exemption available, but doing a needs analysis found out that if the client were to die today, there was about a $2 million tax bill that would be due on death. The other interesting thing is, I don't know how interesting it was, but another fact was that the business produced more than enough cash flow for this individual for their lifestyle costs. In fact, it was generating about $250,000 of net income beyond their lifestyle needs. This client was more of an aggressive investor, both within their business as well as within their investment portfolio outside of their business. So the client was very comfortable with volatility, had a good positive outlook on the markets. And so, I go through this list, I'm thinking, well, UL looks like it's checking an awful lot of boxes for a client with this type of profile. But the client, again, had a goal of getting the $2 million of insurance coverage today to at least cover that calculated tax bill on death today. But again, the client was also intending to continue to be active in the business. They wanted to grow the business over time. And so they wanted their insurance solution to be able to grow with that growing need for coverage over time as well. So the goal was really to get the $2 million today, but also maximize estate values for the next generation and have that death benefit grow over time. So focus is really on death benefit, Capital dividend account was obviously a factor that we'd be looking at, and really looking at net estate values. And so what do we do? Very small numbers on the right. I promise I'll make them bigger for you in a second, but this client, again, was intending to work for 10 years, so they want to be done paying premiums, in their words, within that time period. So at age 70, we're going to utilize about $125,000 of their excess annual corporate earnings over that time period for this insurance solution. Again, the focus is on estate values, not cash values. Risk tolerant investor, we already covered that. And so we then provided 4 options to present to the client. So one is coverage plus UL, again, looking at a 10-pay solution. And we show this client a 4% assumed rate of return, as well as a 5% assumed rate of return. So 4%, think, again, maybe stable growth account. It's all in the stable growth account. Maybe with a 5%, assumed return, we're looking at maybe half stable growth account, maybe half Canada Life's advanced profile managed account. 2 other options that were looked at would be an early value par product, offset at year 11, obviously some ADO to help support that offset, as well as a delayed value par product. And so, we're sort of highlighting in green would be the leading quote unquote solution. In blue, at those various points in time, you have the runner-up, as it were. But in both these scenarios, 4 or 5% assumed rates of return with UL, the UL performed extremely well for this client. Again, they're interested in estate values, interested in CDA, so again, net estate values. UL at 5% performed extremely well all the way through year 35, which would be age 95 for this particular client. Obviously, he's 60 today. At 4%, again, the 4% UL option performed extremely well all the way through age 80. It would be the runner-up. If 5% was off the table, you're only going to get 4 in terms of a assumed rate of return. All the way through 80, the UL option is the better option. Only after that point is when the delayed value par products start to be a little bit better. But even then, past age 80, looking at 85 all the way through 95, the 4% UL option is close. And so that is interesting. Then we looked at, again, these are cash values over time. In the solid lines would be the UL options, either 4 or 5, and then the dashed lines would be par. I would say, UL doesn't perform too badly against the early value par product until, about the early to mid 70s. But I would say if cash value is really a high important issue for a client, par might be your better option. In this case, the client was not really concerned about cash values. Their real focus was on death benefit. And here we're showing death benefits over time. Again, the solid lines would be, in this case, the UL examples, and the dashed lines would be the par examples. Again, UL performed extremely well over the length of the contract, whether you're looking at assumed 4% or 5%. Next question might be, why would we show this client 4% or 5%? So stable growth account, just have 2 pages there on screen with our stable growth account material. Again, we know it's yielding 5 today, but the base crediting rate is 4. So, maybe you want to show 4. But we're also looking at, on the far right hand side here, some of our these aren't all of our other investment options, but there's some of our index and managed accounts. And I would go to the 10-year achieved rates of return. So those are net of fees. Like if a client is comfortable taking on a little bit more risk, again, these are not guaranteed, and I would never show a client, my eye might go to that science and technology fund. That fund has provided 18.86% cumulative, an annual compound rate of return of 18.67% after fees. Do not show clients 18%. I've seen UL examples that have not fared well for a client. The worst case example that I had seen was a UL that was done 10 or maybe 15 years ago. It was assuming a 14% annual rate of return. that was obviously invested in a fund that wasn't guaranteed to earn 14%. In fact, it could have lost 20% in a year. Do not show extremely high rates of return would be my advice there. But showing a reasonable rate of return, 3, 4, 5%, depending on the client's tolerance for risk, can help minimize some of the past, perhaps poor experience that a client may have seen. So just show reasonable rates of return. But for a client like this who's comfortable with risk, they understand the markets, they have a positive outlook on the future. Like, we've got some really good funds that have provided some very attractive long-term net of fee rates of return. American Equity, almost 13%. Again, there's that advanced profile fund, 6.65%. Net of fees, compound yearly, like that. So there are some good investment options for that type of client. And I see we're running out of time, but I just want to show this as well. So this is an example of what would have been shown to the client in terms of, what are your options? So you can deposit $1.25 million over 10 years. That would have grown, that asset would have grown in a world without tax to $3.2 million. Unfortunately, we do live in a world with tax. And so your asset will only end up growing to $1.76 million. So you've lost more growth lost due to tax than you've actually deposited. So you've only deposited 1.25 million. You've lost 1.475 million over that comparison period. How does that make you feel as a client? I'm losing that much, not only to tax itself, but lost growth potential accumulates to 1.45 million. I don't like the sound of that. What are my options? Well, again, we could look at this life insurance option, which provides $2.8 million at age 90. So we haven't got you back to the full 3.2 million that you would have gotten in a world without tax, but we've certainly improved your net estate at time of death compared to your current planning, which is to do investing within your corporation. So again, the client in this example like that, they liked the UL investment solution. They liked the 4 and 5% returns. And so they end up selecting UL in that example. Emily, I know I'm super running out of time. Maybe I'll just quickly talk about this case. So here we have a male 34 who bought term 10 with Canada Life 10 years ago. They were rated. They had a couple things going against them. They were rated. They were a smoker. They were getting a renewal increase from $350 a month now to $1,705, a 500% increase. The client also in 2024 is uninsurable. And so what we're looking to do for this client is extend their coverage for less than the renewal cost. And so what we did was we went, again, age 44, smoker, but we went with an AI 100 product, also utilizing Canada Life's term reset feature. So we reset $800,000 of term 10. And the solution between AI 100 at 1.2 million plus a reset term 10 of 800,000, so still $2 million of death benefit, we were able to reduce the required first year premium payment to a little under $1,300. So we saved them about 25% compared to their existing renewal. Plus, we've given them options for the future. So they could pay that for 10 years. If they do, at the end of 10 years, there's about $50,000 of cash value in their UL policy. They could cancel their UL policy, pull that money out. They could just leave that, maybe let the term 10 go, maybe leave that 50 grand in the UL policy, let it self-sustain, and it could for another 5 years, 6 months. Or they could look at converting their AI 100 to level COI at age 54 for about $2,400. So we've saved this client money today versus their term 10 renewal notice. We've got them coverage for another 10 years, and then we've provided them extra flexibility after that 10-year period to make other decisions with respect to their insurance planning. So I thought that was a pretty interesting case. Emily, I think we might be at time, so I'll just maybe turn over to you. If there's any questions, I'm happy to stick around, but I also want to be respectful of your time.
Yes, we are at time. Thank you so much, Warren. That was great. Please reach out to your BDE in your area. Can you introduction to the wholesaler at Life? Also, if you want to discuss UL suggested rates from IDC, we also have that on record. You can probably search that up through the search function and at idcwin.ca. Thank you so much for your time today. Thank you for showing up. Thank all of our advisors for coming and making the time to maybe learn something new or get a refresher on what Canada Life has to offer. And again, please reach out to your local BDE and they can line you up with an introduction to the rep. Thank you so much. Have a great day.
Thank you.